Hi again, I'm Michael Carr for Banyan Hill Publishing. Welcome to the fourth part of How to Read a Stock Chart 101. I think you're really going to enjoy this part. In this tutorial, I will be walking you through a trade from start to finish. That way, you'll be more comfortable making trades based on what you see in stock chart patterns. So let's get right to it. Basically, you're going to spot patterns on the charts, and then you're going to place your buy and sell based upon what you see on the chart. That'll be the extent of your analysis, and believe it or not, that's all you need to be a profitable trader. I'm going to walk through examples detailing the tactics that are involved in this process. It starts by looking at a chart. This is an ETF. It's an ETF that tracks a Chinese stock market index. And on the right side of the chart, we see the prices have stalled. A lot of times a trader will try to anticipate what's coming next. Well, we're stalled. This could mean we're about to see a double top with a breakdown. But we don't want to trade based on what we think could happen. We want to wait and see what happens. So if prices move up, we want to buy. And if prices break down, we'll want to sell. Now, if you're already long FXI and it stalls like this, you would wait for a decisive sell signal. So if you're long, you would follow along with this strategy using the exact same ideas we're going to talk about for closing the trade. But if prices move up, we want to be long. And to decide if prices move up, we could draw a dashed line at the high, and the very next week, prices break above, out to an all-time new high there, and we're into the trade. So once we're in the trade, we bought at the new high. Now we have to decide when we would sell. We're going to place the initial stop at the midpoint of the trading range, and we'll move that stop higher whenever a new trading range forms. In other words, the price action on the chart will dictate when we get out. So we're in volatility increased over the next 5 weeks, but we haven't really made much movement. So we haven't come down halfway into the pattern. And on this chart, what I've done is highlight the trading range that we were looking at originally. And we bought a breakout of that range. So then we measure the depth of the pattern and put our stop at the halfway point. In this case, we're into the stock, into the ETF at about 38, and the stop is only $2 below that level. So that's our defined risk. We already know what our risk is. We know from our pattern analysis video that the depth of the pattern, in this case about $5, provides us with our initial target. So our risk is $2, our target is $5. Overall, it's a good trade to take, and we know all of that just from looking at the chart. Now, 10 weeks into the trade, we're still bouncing around. This happens. Sometimes we have to wait, but we haven't violated our stop yet, so there's no need to take any action. We watch it week by week. And 15 weeks into the trade, we have a huge breakout to the upside. We hit our price target and surpassed it. This is always a decision point. When you have your gain, should you just take it and walk away? And you certainly can. In this case, you would have had a gain of about 20% had you taken it at the price target. Overall, we end 15 weeks into the trade up 23%. That's assuming we didn't take our profit at the target. So obviously, there's pros and cons to both ideas. Taking it just lets you lock in the trade. You move on to the next one. Letting it run carries risks, and let's see how that would unfold. So we're going to assume we didn't take our profit target. We're just holding on. We have a gain of 23%, but we can move our stop. And in this case, we could move our stop up to the bottom of that big breakout bar. It's a little bit below our initial target, but we still have it closer to the market action. There's other ways to move stops. You can move it to the midpoint of that big range. You could put it just to the low here. Volatility's picked up, so no matter where you place it, you're going to have risk. And the closer you are to the market action, the more likely you are to be stopped out. Considering this is a gain of more than 20%, you might want to consider placing it very close to the market action. We're not doing that, and in this case, we're stopped out on a move, netting only 8%. We allowed a large part of the gain to slip away from us, and that's one of the problems with trading chart patterns. You can, in fact, allow a large gain to fall back into a mediocre gain or even a loss if you're not careful. So you've got to follow the chart pattern. No matter what rule you follow, no matter what rule you decide on, you must stick with it. In this case, we sold here the very next week. Prices collapsed. They came back all the way to the midpoint of our trading range and we would have been out. Prices would in fact fall significantly, more than 30% from high to low in a matter of weeks. So define your risk level and act when the price hits that. Let's walk through another example. November 2016, we had the election coming up in the US. It was a volatile market period, but we had a clearly defined trading range on the chart. And here what I did to find the trading range, I just found a high and a low that had been a nice area of support. In this case, we see 3 times prices came down here to about 204 and bounced higher. So I just draw the range there. We get a downside break and I can project my target. So we enter at about 204. We could enter a downside trade with put options. We can sell short, but that's a very risky strategy, and put options limit risk. Now, our stop would be the midpoint of the trading range. So we measure the trading range, put our stop at the midpoint. Right after the election, stocks rally sharply, pushes right through our stop level. We're out of that position with a loss. Shortly after that, prices break through the top side of the range. Now this is hard, but you're reversing your opinion on the market because that's what the chart tells you to do. Once prices move past that former resistance level here, it's time to get back in. And we then measure and project to the upside. We get a target of about 215. We still have our initial stop, but our price target is very quickly hit. In this case, again, you could take the profit or you can just move your stop closer to the market action. If we were to move the stop closer to the market action, we could use pullback. So each time we get a little dip, we raise our stop. So we do that with each dip in the market price. And eventually we'd be stopped out here at point number 4. We raised our stop here after this dip at 3, and then 4 it just rallied almost straight up. We had the initial little dip, we raised our limit, and we were taken out then. This would have been in April 2017, so we're in the trade quite a while. 8.4% gain in 20 weeks, but we trailed the market up and allowed the market to dictate when we got out. Trading based on charts gives you flexibility. You can just spot these patterns. You can scan various charts of stocks or ETFs. When you spot the pattern, you spot a consolidation, place your buy order, place your stop order as soon as you're filled, and then you can trail your stop up each day. You can combine charts with other indicators, or you could trade them on your own. It's a very flexible and a very productive way to look at trading. Now, thank you again for taking the time to watch our How to Read a Stock Chart 101 series. I hope you found it to be a valuable resource. We're always aiming to improve our educational tools and materials at Banyan Hill Publishing, so be sure to check back frequently. And if you have any questions, you can reach out to us at banyanhill.com.